Welcome to the deep dive. Today, we're really getting into the weeds on the latest numbers from a major player, Kotak Mahindra Bank.
That's right. We're looking at their Q2 and H1 results for the 26 financial year, ended September 30th, 2025. Unaudited, of course, but still very telling.
And we're not just looking at the bank's core financials.
You-
We've got the consolidated group view, the investor presentation, even some key regulatory filings from October 25th.
Exactly. It gives us a more rounded picture. And what's emerging is interesting. There's the split narrative.
Yeah, that's the key thing, isn't it? The core banking stuff, loans, deposits, how good those loans are. It all looks pretty steady, growing nicely.
Solid growth there. But then you look at the whole group, the consolidated picture, and especially the profitability of some key parts. It's been quite volatile.
That's the puzzle. Strong core, but a hit to the overall bottom line. So our mission today is to unpack that for you. Is this a sign of weakness or just maybe some noise from the different business units?
Let's try and separate the signal from the noise. Starting with the big picture, the consolidated health of the entire Kotak group.
Okay, so the number that jumps out immediately is the consolidated profit after tax, the PD. For Q2, it landed at 4,468 crore.
Which sounds like a lot of money, and it is, but the context is key.
Right. Compared to the same quarter last year, Q2 FY25, that figure was 5,044 crore. So that's an 11% drop year on year.
It is, and that 11% decline definitely caught the headlines. But if you step back from just that quarterly profit figure and look at the scale, the balance sheet,
Yeah, the story shifts a bit.
it really does. Consolidated customer assets, for instance, they grew 13% year on year. We're talking 576,339 crore by the end of September. Healthy growth.
And the money they manage overall, assets under management, AUM.
That's up too. Total AUM reached 760,598 crore. That's a 12% jump year on year.
And I noticed within that, the domestic mutual fund equity part grew even faster, like 14%.
Yeah, good spot. Up 14% to 362,694 crore. So, people are putting more equity investments through them, which is generally a positive sign.
Okay, so assets are growing. What about the stability of the foundation? Net worth, capital.
Very solid. Consolidated net worth is up to 167,935 crore. And the book value per share, a key metric for investors, increased 14% year on year to 844.
And crucially, the regulatory buffers, the safety net.
Still look really strong. Consolidated capital adequacy ratio, CAR, is 22.8%. The CET1 ratio, the core equity, is 21.8%, both well above what Basel III requires.
And liquidity looks good too.
Yep, average liquidity coverage ratio, LCR, was 132%. So they've got plenty of liquid assets to cover short-term needs.
Okay, so let's recap the consolidated view. Assets growing strongly, well-capitalized, good liquidity. But that 11% profit drop, it really makes you wonder, where's the pressure coming from?
Exactly. If the overall group structure is sound, the issue must lie deeper. So the next logical step is to isolate the core engine, the standalone bank itself.
All right, take away the subsidiaries for a moment and just look at Kotak Bank. How did it do on its own?
Much more resilient, actually. The standalone PAT for the bank in Q2 was 3,253 crore.
Okay, and how does that compare year on year?
Only a very slight dip, down just 3% from 3,344 crore last year. So much less dramatic than the consolidated drop.
And the core income from lending, net interest income, NII.
That actually grew, up 4% year on year to 7,311 crore.
Okay, NII growth is positive. But, wasn't there something about margins, the net interest margin, NI?
Ah, yes. That's where you see the first real challenge for the core bank. The NIM came in at 4.54% for the quarter.
Which is down from...
Down quite a bit from 4.91% in the same quarter last year.
Wow, okay, so the gap between what they earn on loans and what they pay for funds is shrinking. Why is that happening?
It points directly to rising funding costs. Their average cost of funds for the quarter was 4.70%. It's getting more expensive to attract deposits.
Let's talk about those deposits then, because the report shows they grew deposits overall, right?
They did. Average total deposits were up 14% year on year, reaching over 510,538 crore. Robust growth.
But it's about where that growth came from, isn't it?
Precisely. The real driver was term deposits. Average term deposits surged 20% year on year to nearly 312,000 crore.
And those are typically more expensive for the bank.
Generally, yes. Fixed rate, higher interest. At the same time, their cheaper source of funds, the current and savings accounts CASA, saw its share decrease.
Ah, the CASA ratio. What was that?
It stood at 42.3% at the end of September. That's lower than the 43.6% it was a year ago.
Okay, so they're bringing in money, but they're paying more for it, which squeezes the NIM. It's a trade-off then. Growth versus margin.
It looks like that's the strategic choice they're making right now. Fund the loan growth, even if it costs a bit more in the short term.
And the loan growth is strong.
Very strong. Net advances grew 16% year on year, hitting 462,688 crore. So lending is definitely expanding rapidly.
Crucially, are they maintaining loan quality with this fast growth? What about bad loans, NPAs?
That's the good news part of the story. Asset quality actually improved. Gross NPAs fell to 1.39% from 1.49% a year ago.
And net NPAs? After provisions?
Even better, down to just 0.32%. That's remarkably low, down from 0.43% last year.
So disciplined growth, and they're setting aside more money just in case. The provision coverage ratio, PCR.
Yes, they boosted that significantly. The PCR is now 77%, up from 71% last year.
Can you explain what that 77% really means for our listeners?
Sure. It basically means that for every 100 rupees of loans formally recognized as bad or non-performing, the bank has already put aside 77 rupees to cover the potential loss.
Wow. Okay, that signals a very cautious approach.
It does. Prudent risk management alongside aggressive lending growth.
So if the core bank is growing loans fast, maintaining quality, setting aside plenty for potential losses, and only saw a tiny 3% profit dip, that 11% consolidated drop must be coming from the other parts of the business, the subsidiaries.
Exactly. Now we need to look at those different engines. Banking we've covered, but also capital markets, insurance, and asset management. Which ones caused the drag?
Okay, let's dissect the subsidiaries. Where was the biggest swing?
No contest. It was the insurance business. Kotak Mahindra Life Insurance.
What happened there? The PAT number looked dramatic.
It was. The profit after tax for the life insurance arm was just 49 crore in Q2 FY26. Compare that to 360 crore in the same quarter last year.
49 versus 360, that's an 86% drop. What on earth caused that? A collapse in sales?
Not exactly a collapse in the underlying business, according to the commentary. It seems to be driven by a specific large adjustment.
That adjustment, what kind?
They mentioned taking the full impact of 165 crore adjustment related to actuarial reserves and expenses.
Okay, let's translate that. Actuarial reserves, that's like the money insurance companies have to set aside based on complex calculations about future claims, right?
Precisely. They've recalculated something about their long-term liabilities, maybe future payouts or expenses, and decided they needed to put aside a significant extra amount now. That 165 crore hit flows directly through the profit and loss for this quarter.
So it's more of an accounting or reserving action for long-term prudence rather than the business suddenly performing terribly this specific quarter.
That seems to be the explanation provided. It's a big hit to this quarter's reported profit, but framed as ensuring long-term financial health, a one-off impact, potentially.
Okay, that makes sense of the massive drop. But what about the other subsidiaries? Were they all struggling?
Quite the opposite, actually. This is where the diversification benefit shows up. Look at asset management, Kotak, AMC, and Trustee Company.
How did they do?
Very well. Their PT grew 31% year on year, came in at 258 crore, up from 197 crore.
31% growth, that's strong.
And even more striking was the alternate asset management business.
Right, this is their private equity, real estate, infrastructure funds kind of wing.
Exactly. Kotak Alternate Asset Managers, their PT jumped hugely. It was 104 crore this quarter.
Compared to what, last year?
Just 22 crore in Q2 FY25.
Wow, nearly 5 times higher. So that part of the business is really starting to fire.
It absolutely is. It shows that while one major engine, insurance, took a big technical hit, another, alternate assets, accelerated significantly. It helps cushion the overall blow.
What about the stockbroking arm, Kotak Securities?
That one faced some pressure. PT was down 22% year on year at 345 crore compared to 444 crore.
So some headwinds there. But were they gaining customers or market share?
Yes. That's the counterpoint. Their market share in the derivatives segment actually increased quite a bit, from 13.0% last year to 15.1% this year. So competitively strong, even if profits were squeezed, perhaps by market conditions or investment spend.
Interesting. And there was also a note about consolidating their microfinance businesses.
Correct. They completed the merger of Sonata Finance with BSS Microfinance. It officially took effect in October, but the appointed date was back in April. It's about streamlining that segment.
Okay, so that covers the main business segments. What about things like governance and leadership? Any important updates there?
Yes, a pretty crucial one. The Reserve Bank of India, the RBI, gave its approval for the reappointment of Mr. C.S. Rajan as the part-time chairman of the bank.
Ah, okay. So continuity at the board level. For how long is the reappointment?
It's for a further period starting January 1st, 2026, and running until October 21st, 2027.
And that date, October 2027, is significant.
It is. It coincides with the end of his current term as an independent director on the board, so it aligns his chairmanship tenure nicely, provides stability.
Good to know. And any other compliance points mentioned?
Just the standard but important confirmation that they submitted their asset cover ratio calculation as required by SEBI, the market regulator, basically ticking the regulatory boxes.
Okay, so we've gone through the consolidated view, the standalone bank, the subsidiaries, and governance. Let's try and pull it all together. What are the main takeaways for someone trying to understand Kotak's current position?
I think the first key takeaway is the fundamental health of the core bank. Lending growth is strong. Asset quality is excellent, even improving. That's the bedrock.
But point two, there's that pressure on the net interest margin, the NIM. The cost of funds is rising because they're relying more on those expensive term deposits. The CASA ratio slipped.
Exactly. That's the main structural challenge for the bank itself right now, how to manage that funding cost pressure.
And third, the consolidated profit drop, that 11%, was overwhelmingly driven by that one big technical adjustment in the insurance subsidiaries' reserves.
Right. It masked the strong performance elsewhere, particularly in asset management and the huge jump in alternate assets. The diversification strategy is working in the sense that different engines perform differently, but it caused volatility this quarter.
So the conglomerate model shows both its strengths, diversification, and its potential for, well, headline noise when one part has a big adjustment.
Precisely. You have to look past that headline PT figure this quarter to see the underlying trends.
Okay, so looking forward, they're pushing their core India strategy, digital platforms like Kotak 811 for customer growth, but that funding mix issue seems central.
It really does. Which brings us to our final thought for you to consider.
Given this continued shift towards more expensive term deposits to fuel that impressive loan growth, how sustainable is it?
Yeah, how long can the growth in other areas like fee income or those strong profits from asset management and alternate assets really offset the squeeze on the core banking margin, the M?
That feels like the key question. Can the other engines compensate enough if funding costs for the main bank keep rising?
It's definitely something the market will be watching very closely in the coming quarters. How does that M evolve, and does the overall profitability hold up against that pressure? Something to think about.